Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us from the MarketSite studio in Times Square, New York City, we have Michael Normyle. He's Nasdaq's U.S. economist, and we're going to discuss why there is a sign of home slowing. Pressure is easing a bit with prices, but not necessarily a sign of a crash. Michael, it's great to have you with us. Welcome to Trade Talks.
Thanks, great to be here.
You got it. Let's start with an overview of weekly performance in stocks and bonds because, of course, we have Fed interest rate hike decision next week, and we're in the thick of Q2 earnings.
Sure. So in the last week or so, the major equity indexes are up, 4 to 6% or so, and a lot of that has to do with, a week ago there were fears that the Fed might hike by 100 basis points next week, but that's kind of that was in response to the CPI report. But now that's kind of faded with some Fed officials coming out in favor of 75, depending on data that comes out in the interim. And then with Q2 earnings data that's come out so far, we've had pretty good reports from a few banks. Citi, Goldman, Bank of America all beat their earnings estimates. And Netflix, they lost fewer subscribers than were projected. And so we haven't gotten any of the kind of major red flags that investors were worrying about on the economy from the earnings so far. So that's helped with the market performance, but bond markets have been a bit more cautious. The 10-year Treasury yield's been kind of hovering around 3% in the last week. So that keeps it about 50 basis points below its high from last month.
Why was the Fed's first rate hike an inflection point for the housing market, and how did it impact affordability?
Well, the inflection point actually kind of dates back to early January when the Fed minutes for December came out, and that showed that they were going to tighten faster and sooner than markets were expecting. And they've only kind of ramped that up in the interim with the series of rate hikes that we've had so far. So as markets have priced that in, 30-year mortgage rates are up about 240 basis points this year. And so that combined with high prices for homes, which they just hit a record high today, or for the June data that came out today, they have made homes, increasingly unaffordable. So we've seen existing home sales drop about 20% since January. New home sales are down about 15% since December. And over that same time frame, mortgage applications, which naturally lead the home sales, they've continued to fall through July, so it's likely that the slowdown in housing is going to continue. So,
Michael, the key question is here, do you see signs of house price relieving, or could we potentially see a housing crisis like we saw in 08 and 09?
Sure. So even though the data for June that came out today hit a new high, we are seeing a larger share of homes with price drops. So that's, signs of it maybe coming off the boil a little bit, but the early 2000s style crash is not as likely, with lending standards being much tighter over the past decade. So actually mortgage delinquency rates hit a record low recently. So that, plus the fact that supply is still pretty tight, might put a bit of a floor under the kind of collapse fears.
All right, Michael, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.